Hello everyone and welcome back to my channel. If you're a returning viewer, you might notice that I've adopted a new format for thumbnails and channel art. Please leave your feedback in the comments. I would like to thank everyone for your support on my past two videos. It encourages me to produce more content. If you're enjoying my videos, please don't forget to like and subscribe. Today we will be looking at two big Canadian REITs that I have a large percentage of on my portfolio, and I will be giving a slight overview of them. This will not be a very in-depth video, simply just an overview of two companies for your guys' watch list. Please remember that I am not a financial advisor and you should do your own research before investing in stocks. We are going to start with a very popular REIT, Riocan. Riocan focuses on real estate, with 33,659 square feet currently available for retail lease and 773 under development. Riocan has a small play on office real estate with 2,318 square feet of office space available for lease and 520 under development. 52% of their retail and office revenue comes from the GTA, and the other 40% comes from Ottawa, Calgary, Montreal, Edmonton, and Vancouver. The important trend to recognize here is that Riocan has most of their revenue coming from the main economic hubs in Canada. These are their top 10 tenants by percentage of revenue. The only tenant that slightly worries me here is Cineplex, but apart from that, these are all solid tenants with long lease terms. Given that 75% of their tenants are considered essential, and they have great locations on all of their properties, Riocan has been able to collect 85% of their rent from their tenants, with more than 8% on a definitive payment schedule. This is great news, as the company still has a lot of cash flowing into it to maintain its operations, and therefore it does not need to rely on credit lines to stay afloat. The last point I want to touch on is residential properties. Recently, the Riocan management team has started to diversify their portfolio into residential real estate. The trust has completed 3 projects and has 7 more under development, which will deliver 2,700 rental units in total. I will not go into further detail on Riocan, as there are already some amazing in-depth reviews of the company on YouTube. If you want further details, I will leave a link to a really good deep dive into the company's financials done by Griffin Milks. This is my current position on Riocan. I own 48 shares at an average price of $15.44. Currently, the shares of Riocan are trading at about 0.6 price to book value, which provides an amazing entry point for any value investor. I am receiving a monthly dividend of $5.76 from Riocan. The next REIT we will look at is Granite Real Estate, which is an industrial real estate company. This REIT owns warehouses and distribution centers. These facilities are the backbone of e-commerce, and as we will see later on, this REIT has capitalized on the growing e-commerce trend. Granite owns 104 properties with 45.2 million square feet of leasable area. Granite has not been negatively impacted by COVID, as it has collected 99% of its rent from its tenants. Here are the top 10 tenants that make up 65% of Granite's total revenue. My only concern with this REIT is that 40% of its revenue depends on Magna International. Magna is a $20 billion car and truck parts producer. They are the biggest manufacturer in North America of truck parts. In the recent quarter, their revenues fell by about half, and they posted a net loss. Even though analysts are not always right, they provide a guide for whether there is a positive or a negative outlook for a company. And the good news is that analysts have estimated that Magna's earnings per share will jump back to pre-COVID levels by next quarter. Regardless of whether Magna will bounce back or not, it is never good to be so dependent on one source of revenue. Therefore, Granite has stated that its main goal looking forward is to reduce their exposure to Magna as a tenant. Granite has maintained 99% occupancy rate across all of its properties. I'm not going to deep dive into the company's financials, but here are some highlights from this quarter. For the 3 months ending June 30th, Granite's revenue increased 16% year over year. Its funds from operations increased by 19%, and its FFO to payout ratio decreased by 6%. All of these highlights show us that the company has managed to continue to grow, even when the pandemic was going on. This is mostly due to their tenants not depending on customers to be there in person for sales to happen. Overall, Granite is an amazing way to capitalize on the growing e-commerce trend that we are seeing. And Granite is more of a pandemic-proof real estate investment trust, as it actually benefits from people staying at home and ordering products online. I personally own 9 shares of Granite at an average price of $65.45. I have made unrealized capital profits of 18% with these shares and receive a 2.17 monthly dividend. Before ending this video, Wealthsimple Trade is currently hosting a $5,000 giveaway. Every time that someone signs up for Wealthsimple Trade using my link in the description, I get 1 entry into this giveaway. To thank you guys for the support on these videos, if I win one of these $5,000 prizes, I will withdraw $1,000 from my account, randomly pick one of the people that use my referral link, and e-transfer them $1,000. If you're not yet using Wealthsimple Trade, click the link down below, sign up, and we will both get free $10 to trade with. And on top of that, you get a chance at a $1,000 cash prize. With that, I would like to thank everyone for watching this video. Please don't forget to like and subscribe, and I will see you next video.